Hi friends, we are going to be talking about chart patterns today. Some chart patterns I would like to discuss with you. Although there are unlimited chart patterns, we cannot be discussing all of them because that is a never ending. There are over 200 chart patterns in the market, and I would like to discuss some basic patterns with you. And as you grow more advanced, uh, you will be basically in a position to understand the advanced chart patterns. So let's go to the next slide. So what we have here is basically two chart patterns. This pattern is called a double bottom pattern and a triple bottom pattern. These are basically bullish candlestick patterns where one can go long above the neckline. Now, what is a double bottom pattern? Double bottom pattern is the market is in a downtrend. Bears have taken it here. At this point, the bulls start fighting in. They take it up to a point. Again, bears start bringing the price down. The bulls again start raising it, and after a point, they just break through this resistance. So, if you see here, this is called the neckline. It's obviously horizontal, and since I've drawn it, it's appearing a little awkward because I don't have a ruler to draw with. So, a double bottom pattern is basically a bullish pattern where the bears try to bring the price one time, two time down. Bulls finally overpowered them and they go up. And your entry can be taken on the breakout of the neckline or a retest, breakout and retest. And your stop loss will be below the bottom, slightly below the bottom. If you want to reduce your stop loss, depending on how you trade, you might keep it halfway, up to you. So this is the double bottom pattern. The triple bottom pattern again is similarly like that, where the bears try three times to bring the price down, and finally the bulls overpower them and the price breaks through. Again, you can take an entry above the neckline on a break of the neckline or a break and retest of the neckline. Stop loss goes slightly below this bottom. Okay. Now, how does this look in real life? Now, this is an example of a double bottom. Double bottom is nothing but the price touching the same level twice. So it will not be a textbook W pattern. Some people call the double bottom pattern a W pattern as well. So up to you what terminology suits you. But double bottom is the technical name. So price bears bring it down, bulls go up, bears bring it down again, bulls go up, and can you see above the neckline, if imaginary neckline here, and they go up. So this is a double bottom pattern, and it can be like this, it can be like this, it can be small w, wide w, but basically it's two touches at the same level, almost the same level. Again, it doesn't have to be exactly the same level. Even if it's a little above or a little below, that's okay, it's still a double bottom. So two times the bears tried and the bulls overpowered in the second time long, and off they go on top of the neckline. Like I said, you can take it at a break here, or if you see break, again a retest of the neckline, then it goes up again. So up to you how you want to trade. Ultra safe people can go for a retest, otherwise you can go with the breakout. Let's go to the next slide. This is an example of triple bottom. Bears are bringing the price down, bulls took it up, bears bring the price down again, bulls took it up again, bears bring it down again. So one leg, two leg, three legs down by the bull, and the third leg by the bull succeeds and it goes up. See, it goes up. Again, there is a retest of the neckline. Not exactly, but if you will, there's some sort of retracement, like a flag and pole, and then it shoots up. So again, how you want to trade? This is again bullish chart pattern. Candle charts make up the pattern. These patterns basically come from a Japanese trader who basically studied the charts and for a long time and realized that price moves in certain patterns, and these patterns are historical and they keep repeating themselves across various time frames, whether it's daily, weekly, monthly, hourly, 15 minutes. So this is one pattern. Now, exact opposite of the double bottom, triple bottom is the double top and the triple top. So again, like I told you, bulls try here, bears bring it down, bulls try again, and bears bring it down again. So once this price breaks the neckline, you can go short. Similarly with the triple, three times the bulls tried, and the third time the bears finally pushed through. You can again have a short entry in intraday on the break of the neckline and stop loss above the tops, or entry on the break and retest, and then you go for it. Some live chart patterns displaying this. You have a double top here. Example of double top. Uh, just one thing very important to note is one thing very very important to note is that chart patterns are rarely what you see in the textbook. Now this double top is also called M pattern. Like people call the double bottom as W. This is a reverse of W, so it's an M pattern. People call it M. People call it double top. So bulls push, bears bring it down. Bulls push, bears bring it down again, and then price goes down. So this is double top. Similarly, triple top. So three times the bulls try to take the price up, but the bears bought it down. Now, if you note here, price really did not break below the neckline here and continue downward. Instead, it went upward. So there is no holy grail in price action trading or in chart patterns. There is nobody in the on earth or in the universe who can give you a strategy or a technique which will give you 100% accuracy and profits always. There are always going to be things that don't work out. All you need to do be all you need to do is be consistent in your risk management, in your entry, in your strategy, your win-loss ratio, your position sizing. And if your strategy has a good accuracy, 50% and above, and if your risk ratio is more than 1 is to, if you if you have an accuracy of more than 50% and your win ratio is even 1 is to 1, you will end up making money. If it's 1 is to 2, you'll end up making more. If your accuracy is less than 50%, and if you still your risk reward ratio or your R multiple is more than twice, you will still make lots of money. So there are plenty of ways to make money. All you need to do is be consistent in your approach and your mindset. Okay, so nothing is foolproof. There is no holy grail. So what we see here is your triple top. Now we have head and shoulders pattern. The patterns that I've shown here are basically popular patterns in the market. So this is the left shoulder. This is like a human head. The right shoulder, and here there is the neckline. So this is basically a bearish candle pattern, and you can short below when the price breaks through the neckline or a retest of the neckline after breakthrough. So here what's happening is bulls tried take it up, bears bought it down, bulls took it up again, this time higher than this one, but bears brought it down again. Bulls tried it again here. The right shoulder may not be exactly at this level, can be slightly above, can be slightly less, that's fine. Even if it's slightly less, that's even better that the bulls are weak. They weren't able to even touch this level. Price comes through here and breaks through. You can place a short here, intraday equity short here, and stop loss will be above the right shoulder. It will not be above the head like double bottom or triple bottom. It will be above the right, slightly above the right shoulder. Please don't forget this. This is a very different distinction. And you can either take a trade as soon as the price breaks out, or break out and a retest and then it goes downwards. This is a bearish candlestick pattern where one can go below or short below the neckline. Reverse of this is the inverse head and shoulders pattern. This pattern basically is a bullish candlestick pattern where one can go long above the neckline. The fundamental or theory is bears tried to bring it down, bulls took it up. Bears did a further push, they went below the left shoulder, but this was the end of the limit of the bulls' patience. They bought it up again. Then bears tried again one more time. So the bears tried once, they tried twice, they tried third time, and the bulls finally in a push broke through the neckline, and there you go. This is like a human. This is your head, this is your shoulder, this is your left shoulder. So this is the reverse basically, as if you're hanging upside down. So you can take an entry At the break of the neckline or a retest of the neckline, stop loss will be below the right shoulder. Here is the pattern, the head and shoulder patterns in a real chart. You see here, this is how the candles are forming. So it's not like a textbook, like every price is in a straight line here, 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 straight line here. So it's basically, this is how the chart pattern will appear in a real chart, and they'll not be ditto like you see in a textbook. So below this, you see, below the neckline price has gone down. So you would have made a decent amount of profit. If you were trailing, your stop loss would have been hit somewhere here. Let's go to the next one. This is an example of the inverse head and shoulders. This is how price went down, went up a bit, went down, went up a bit, went down, up. And there it finally broke the neckline, and there it goes. Up it's gone. So this is what we have for the head and shoulders pattern. So I basically taught you three patterns: double top, double bottom, triple top, triple bottom, inverse head and shoulders, head and shoulders. So these patterns basically are the popular ones out there, and you can trade these. I hope you're taking down notes and you're enjoying your learning so far. And if you like my training, please give me a thumbs up and a 5-star rating on Trustpilot. And I wish you all the best and see you in the next lesson. Bye.